Welcome to the third Dunham Quarterly Snapshot of 2024. Each quarter, we share key insights on global markets and the economy, all summed up in just a few minutes. Let's dive in.
The biggest news in the third quarter was the Federal Reserve's first rate cut in over 4 years, reducing the federal funds rate by 50 basis points in September. This larger-than-expected cut was in response to inflation cooling to 2.5% by August. Fed Chair Jerome Powell described the move as part of a broader strategy to ease monetary policy while maintaining economic stability. This cut may mark the beginning of an anticipated series of rate reductions through 2024 and 2025, aimed at supporting the labor market, which has shown more weakness than expected, and ensuring inflation continues to decline. U.S. stocks rose again in Q3, driven not only by optimism around the Fed's rate cuts, but also by strong corporate earnings, solid economic growth, and resilient consumer spending. In the third quarter, the S&P 500 rose by 5.89%. This increase continues the positive trend for U.S. stocks in 2024. Markets were volatile throughout the quarter, marked by sharp gains and drops as investors reacted to uncertainty around interest rates, inflation, and economic conditions. The tech sector, especially Nvidia and Microsoft, played a big role in these market swings. Adding to the volatility, the U.S. CBOE Volatility Index, or Fear Index, spiked to its highest level since the banking crises in March of 2023, reflecting growing market anxiety. Meanwhile, global markets experienced a rally. The MSCI All-World Index ex-US advanced by 6.61%, bolstered by rate cuts from the Fed and China's stimulus, which fueled optimism and lifted international markets. Furthermore, in fixed income markets, returns improved as well. The Bloomberg U.S. Aggregate Bond Index increased by 5.20%. Easing inflation and a softening labor market contributed to expectations of more aggressive Fed rate cuts later in 2024. Many advanced economies, including the U.S. and Eurozone, experienced moderate growth. The U.S. showed resilience, with economic growth around 2.3%, but rising consumer debt, missed payments, persistent service inflation, and a cooling labor market are concerns. Europe, too, saw sluggish growth. However, the real concern globally is what is being called the China slump. China's economic slowdown that threatens global growth. As the world's second-largest economy, when China slows down, everyone feels the friction. China's GDP growth has decelerated to around 4%, its lowest outside the COVID period. The country is facing an imploding real estate sector and weak consumer demand, and this slowdown is rippling through global trade, especially affecting Europe. In response, many companies are shifting manufacturing out of China to countries like Mexico, India, and Vietnam, reshaping global trade. Domestically, the tech sector remains a key driver of U.S. growth, with heavy investments in AI and machine learning. While this innovation supports the economy, it is also raising concerns about over-reliance on tech stocks, market saturation, and diminishing returns. Outside of tech, the Fed's recent rate cuts are expected to boost consumer demand and borrowing, which could provide support to housing and manufacturing sectors that have struggled with high rates, but at the risk of overburdening households with even more debt, which may become unsustainable long-term. Looking ahead, while potential headwinds could dampen gains or increase volatility, markets continue to rally, and the Fed's rate cuts may help boost sentiment. Though it's too early to predict if these trends will persist into Q4, we remain optimistic and will be monitoring the situation closely.
Thank you for joining us for the Q3 2024 Dunham Quarterly Snapshot. Be sure to subscribe to our Dunham blog and YouTube channel to stay ahead in the markets. Until next time, take care and enjoy the rest of your year.